You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is Tuesday, January 13th, 2026, and today we are looking at Delta Airlines, fourth quarter 2025. And just a quick reminder before we start, Miro and I are just two friends looking at the numbers. Nothing we say here is financial advice, just our personal takes.
Yeah, if you take investment advice from a podcast, you have bigger problems than Delta's fuel costs.
Fair enough. So, Miro, Delta. On the surface, it looks like a victory lap. Revenue came in at $16 billion flat, which is a record for a December quarter, even if it's down seasonally from the summer high. But reading the release, it felt a bit loud, like they were trying very hard to tell us how great everything is.
Loud is the right word. Look, the headline numbers are fine. They posted GAAP earnings per share of $1.86. That is down from the $2.18 they did in Q3, but that's seasonality. Nobody expects people to fly as much in November as they do in July. Operating income was $1.5 billion. Again, solid. But the market reaction was very interesting.
Oh, totally. Did you see the pre-market action? It fell off a cliff at like 7 a.m., then V-shaped right back up. It eventually closed at 69.33, up almost 2%. It felt like the algorithms read the headline, got scared, read the footnotes, and then decided to buy.
Yeah, I think the algorithm saw the government shutdown impact and panicked for a second. They explicitly mentioned a $200 million hit from the shutdown in December, which is, to be honest, a very convenient bucket to throw any underperformance into.
You think they're padding the excuse?
I think when you have a messy quarter, you take every one-off you can find and put it in bold print. But looking past that, the thing that actually matters here isn't the passenger revenue. It's the cash. They hit a record free cash flow for the full year, $4.6 billion. That has a lot of liquidity for an airline.
Right, and they're paying down debt too. But here's the thing that caught my eye, Miro. They're talking a lot about, fixing other people's planes. MRO revenue, maintenance, repair, overhaul, it's up 25%.
Yes, finally. So see, this is the story. Everyone thinks Delta is an airline. Delta is rapidly becoming a bank that owns a repair shop. The MRO business, growing 25%, is huge because that is high-margin, sticky revenue. And next quarter, they're breaking it out as a separate line item. That is a signal. They want the market to value that piece differently than the metal flying in the sky.
So they're telling us don't look at the low-margin seats, look at the engine shop and the Amex card.
Exactly. And honestly, it's working. The balance sheet is cleaner than it's been in years, but there is a little bit of smoke and mirrors in how they're presenting the costs.
Okay, I want to pull on that thread because the cost structure looked a little creeping to me too. Let's dig into what those numbers actually mean.
Right, so the creep is real. If you look at the unit costs excluding fuel, what we call CASM-X, they were up 4% year over year. Meanwhile, unit revenue, flat, zero growth.
Oof. So it cost them 4% more to fly the plane, but they didn't make an extra dime per seat?
Basically. And that squeezes margins immediately. Operating margins slipped to 9.2%, which, look, is still decent for an airline in winter, but the trend line is going the wrong way.
But to be fair, they still generated $16 billion in revenue. That is a record for a fourth quarter. So people are definitely flying.
They are flying, but they are flying differently. That $16 billion isn't coming from the back of the bus. Passenger revenue overall was barely up, just 1%. The real growth is entirely in premium.
Right. Premium revenue was up 7%. It feels like the whole strategy now is just upsell everyone. If you're in main cabin, you're basically cargo that talks.
Cargo that talks. That's harsh, but the data backs it up. Ed Bastian explicitly said they haven't seen main cabin pricing move at all. It's stagnant. The money is in the front of the plane and in the credit card fees.
Which is wild given how full the planes are. But speaking of where the money goes, can we talk about the profit sharing? Because despite the margin squeeze, they're paying out $1.3 billion to employees next month.
Yeah, Valentine's Day came early. Honestly, I respect that.
In this industry, if your pilots and flight attendants hate you, your operations collapse and your margin goes to zero anyway. It's an expensive insurance policy, but it works.
And looking ahead, they seem pretty confident. They're guiding for 2026 earnings per share between $6.50 and $7.50. That is, 20% growth?
It is. It's aggressive. They're banking on a 5 to 7% revenue jump in Q1. They also claim their fleet strategy, adding these new Boeing 787s alongside the Airbuses, is finally hitting a quote-unquote Goldilocks state.
Wait, did he actually say Goldilocks?
He did. Not too hard, not too soft. I prefer engineering terms to fairy tales, but if it lowers CapEx, I'll take it.
Okay, so we have record revenue, rising costs, and a CEO quoting children's books. But Miro, there is a specific accounting change buried in this report that I think explains why they're so confident about hitting those aggressive targets.
Oh, the magic eraser. Yeah, that is where the real financial engineering is happening.
Exactly. All right, that's the top line, but the really interesting part is how they're about to rewrite the scorecard itself.
So here's the trick. Starting in the first quarter of 2026, Delta is changing how they calculate their non-fuel unit costs. They're explicitly stripping out the expenses related to MRO, that booming maintenance business we just talked about.
Wait, but MRO is growing like a weed. Why would you want to hide the costs of your fastest growing segment?
Because MRO is heavy. It's labor-intensive, it requires parts, it's messy. If you keep those costs mixed in with the airline operations, it inflates your CASM, your cost per seat mile. As the repair business gets bigger, it mechanically makes the airline look less efficient on paper.
Ah, I get it. It's like if you're trying to run a marathon and you decide to take off your heavy backpack before you step on the scale, you didn't actually lose weight, but the number looks a lot better?
Basically, yes. They call it preserving visibility into core airline costs, which is technically true, but it also means that next quarter when they report unit costs, the number is going to drop artificially. It's an optical reset. It allows them to say, look, the airline is running leaner, even if the total expense pile hasn't changed.
That is clever. So they are effectively splitting the company in the eyes of the investor. You have the messy, low-margin airline over here, and then you have this high-growth industrial repair shop over there.
Exactly. And that is only half of the rebrand. The other half is the credit card.
Right. The Amex remuneration. I love that word. It sounds so much more polite than we made $8 billion swiping plastic.
$8.2 billion, actually, up 11%. Think about that number, Susie. That is not revenue from flying planes. That is pure margin from selling miles and brand access. And here's the other accounting shift. Starting next year, they're reclassifying a bunch of ancillary and miscellaneous revenue into the loyalty bucket.
So they're padding the loyalty line item?
They would say they are better reflecting how they manage the business. But the net effect is that the loyalty revenue number is going to get even bigger. They are screaming at the market, stop valuing us like a cyclical transportation stock. Value us like a bank that happens to own some airplanes.
The Un-Airline strategy. You know, it reminds me of when fast food chains realized they were actually real estate companies. Delta is realizing it's a membership club.
It is. And honestly, it's the only way to survive in this industry long term. Flying people is a terrible business. It's capital intensive, unionized, and weather dependent. Selling credit card points? That's infinite gross margin.
But that brings up a risk, doesn't it? If their entire profit engine is tied to American Express spend, what happens if the consumer cracks? We saw main cabin pricing stall. If people stop swiping the card, the engine stalls too.
That is the $11 billion question. You can strip out MRO costs, you can reclassify loyalty buckets, but you cannot engineer away a recession. If the premium consumer pulls back, this whole Goldilocks structure starts to look very fragile.
And yet, they're buying 30 new Boeing 787s for the 2030s.
That's a 20-year bet on the consumer showing up.
It is. And maybe that is the confidence we should be watching. They aren't managing for next quarter. They're building a fleet for the next decade. Though, I admit, the Goldilocks quote still bothers me.
Let it go, Miro.
I'm trying.
So, yeah, that's the part that really changes how I see their whole strategy. It's not just about flying anymore. It's about financial engineering the perfect conglomerate.
Mm-hmm. It's sophisticated.
So, where does this leave them heading into next quarter? Are they a buy, a hold, or just a really interesting science experiment?
I think it is a science experiment that is actually starting to work. Look, if they hit that 2026 guidance, growing earnings 20% to around $7 a share, the market won't have a choice but to respect the multiple. They're proving that cash flow can be consistent even when the world is chaotic.
Right. But that confidence assumes the premium wall holds. We already saw the main cabin weakness. If that cracks upward, if the corporate traveler pulls back, that 20% growth evaporates fast.
That is the risk. It's a leverage bet on the upper middle class. And operationally, they aren't bulletproof yet. Bastian admitted it himself. They still have work to do after the summer mess. You can have the best credit card program on earth, but if the plane doesn't leave the gate, the brand creates friction, not loyalty.
Yeah. It's a trust fall with the consumer. You know, for a company talking about Goldilocks and perfect balance, it feels like they're walking a pretty high wire.
High wire, high margins. That's the trade. But with $3 or $4 billion in free cash flow expected next year, at least they have a net.
A very expensive, very comfortable net.
Exactly.
All right. Let's land this thing.
Landed, though I am definitely keeping my eye on those maintenance margins next time.
I know you will. And that is it for our look at Delta. But before we sign off, I want to take a brief moment to explain exactly what Earnings Unscripted is. This show is an experiment. It is being built by a small team of enthusiasts who are exploring the frontier of AI and how it can be used to enrich us. This entire episode, from the research analysis and script writing to the fact-checking, and yes, even the voices you are hearing right now, was created by a team of AI agents. We are all working together with human oversight to deliver high-quality, up-to-the-minute information that would hardly be possible otherwise. The goal is to prove that automated content doesn't have to sound robotic. It can be accurate, insightful, and human. So if you have questions, comments, or just want to reach out, please do. You can email us at earningsunscripted@datamadness.ca or follow the project on X.
Yeah, thanks for listening. See you after the next call.